In this review you will understand what an income statement, also known as a profit and loss statement or statement of operations is. It provides a summary of a company's revenues, costs, and expenses over a specific period, typically quarterly or annually. Here's a breakdown of the key components of an income statement. 1. Revenue, sales. This is the total amount of money generated from the sale of goods or services. It's the starting point of the income statement. 2. Cost of goods sold, COGS. This includes the direct costs associated with producing goods or services sold by the company. It covers expenses like raw materials, labor, and manufacturing overhead. 3. Gross profit. Calculated by subtracting COGS from revenue, gross profit represents the profit made from the core business operations. It indicates how efficiently a company is producing and selling its products. 4. Operating expenses. These are the costs incurred during regular business operations. They include items such as salaries, rent, utilities, and marketing expenses. Operating expenses are subtracted from gross profit to get operating profit. 5. Operating profit, operating income. This is the profit remaining after deducting operating expenses from gross profit. It shows the profitability of the company's core operations. 6. Other income and expenses. This category includes non-operating items such as interest income, interest expenses, and gains or losses from investments. 7. Net profit before tax. This is the total profit before accounting for income tax expenses. 8. Income tax expense. The amount of income tax a company owes to the government based on its taxable income. 9. Net profit after tax, net income, calculated by subtracting income tax expense from net profit before tax. This is the final figure representing the company's overall profitability. Understanding the income statement is crucial for business decision-making. It provides insights into a company's revenue, costs, and overall profitability, helping stakeholders assess financial performance and make informed strategic choices. Deciphering the income statement sheet involves examining key line items and ratios to gain insights into a company's financial performance. Here's a step-by-step guide to crack the code on your income statement. 1. Revenue or sales. Reflects total income from products or services. Investors look for consistent revenue growth over time. 2. Gross profit. Calculated as revenue minus direct costs, material, labor, indicates profit after deducting costs to produce and sell. Gross profit margin shows efficiency in converting revenue to profit. 3. Operating expenses. Indirect costs like research, marketing, administration, and staff salaries. Analyze line items for unusual jumps that may signal issues. 4. Operating income, EBIT, remaining amount after deducting operating expenses from gross profit. Operating margin reflects operating profit per dollar of sales. Compare margins over time and against competitors. 5. Interest and taxes. Interest expenses deducted to get to pre-tax income. Income taxes deducted to calculate net income or profit. Net margin shows net income as a percentage of revenue. 6. Non-recurring items. One-time events like asset sales or lawsuits. Note when comparing profitability over time. 7. Red flags. Declining revenue, contracting margins, or rising costs are warning signs. Compare against historical trends and industry averages. 8. Footnotes. Crucial details are often found in footnotes. Indicate accounting changes, acquisitions, lawsuits, and segments losing money. 9. Comparisons with competitors. Analyze income statements of direct competitors for perspective. Consider industry benchmarks, but be cautious of differences in size and industry. 10. Understanding accounting policies. Aggressive revenue recognition or liberal depreciation policies can distort the statement. Awareness of financial statement accounting rules is essential. 11. Outsized losses. Large losses may result from failed projects or asset write-downs. Beware of big bath accounting, where managers intentionally reduce asset values. 12. Ratios for context. Assess profitability with ratios like gross, operating, and net profit margins. The return on assets, ROA, ratio evaluates asset utilization. 13. Forecast future profits. Trends in revenue, margins, and expenses help estimate future profits. Useful for determining if a stock is undervalued or overvalued. Taking your analysis of the income statement sheet to the next level involves delving deeper into specific aspects and understanding the nuances of financial reporting. Here are some expert tips. 1. Fine-tooth comb on revenue records. Examine when revenue is recorded based on accounting rules. Understand principles of realizable revenue versus contingent future revenue. Investigate revenue recognition methods to gauge the quality of reported revenue and profit. 2. Distinguish between gross profit and operating profit. Gross profit considers direct variable costs, while operating profit includes fixed and overhead costs. Analyze gross profit margin for production efficiency and pricing power comparison. Explore operating profit margin for overall operating efficiency across the organization. 3. Maximize gross and operating profit. Companies aim to maximize both metrics by reducing direct costs and streamlining operations. Track trends in gross margin versus operating margin over time for a comprehensive view of profit engines. 4. Recognize profit as estimates and assumptions. Understand that the numbers in income statements are estimates and assumptions, not absolute facts. Appreciate the art of finance in generating and interpreting these assumptions. By applying these advanced techniques, you can gain a more nuanced understanding of a company's financial health and performance, allowing for more informed decision-making. In summary, developing a basic understanding of accounting principles is essential for making informed financial decisions. Deciphering an income statement sheet is a fundamental skill that provides insights into a company's financial health and potential for future profitability. This mini-blink has touched upon just one aspect of financial intelligence, and for a more comprehensive toolkit, it is recommended to explore the full book. Welcome back, and a heartfelt thank you for rejoining our knowledge-rich community. Within these digital walls, you'll discover a treasury of engaging book summaries crafted to equip you with insightful reflections and motivational narratives, encouraging profound actions. As we strive to broaden our impact and share the joy of learning, we extend an invitation for your support, simply by liking, sharing, and subscribing to our channel. Your support isn't just valued, it serves as the bedrock of our mission. In return, we commit to consistently furnish you with top-tier book summaries promptly. Let's persist in this collective journey toward growth and enlightenment. Here's to delightful reading, perpetual learning, and continuous personal development.